Hello and welcome to this recording in which we will look at marginal costing. We will consider what is meant by marginal costing, how to prepare marginal costing statements, and then compare and explain differences in profits between absorption and marginal costing statements. So what do we mean by marginal costing? Well, it's another form of costing, and it classifies all costs into two categories. It will consider costs to be either variable or fixed. Within marginal costing, when we work out the production cost of the products, we only include the variable costs. The overhead costs we treat as a fixed cost in the period in which it's incurred. So in other words, it is referred to as a period cost. This means that with marginal costing, overheads are not absorbed. So there's no requirement to allocate overheads to cost centres. There is no need to apportion overheads to cost centres, and there is no requirement for an overhead absorption rate or a calculation of under or over absorption. Marginal costing is generally used for internal short-term decision making. By short-term, we mean within a 12-month period. As such, marginal costing statements cannot be used for producing financial reports. So we'll have a look at two definitions. So when we are talking about the marginal cost, which can also be referred to as the variable cost, we are considering how much it costs to produce 1 unit of the product, and those costs would be avoided if the unit were not produced. So in other words, what we are considering are purely the variable costs of production. Another term that you will come across with marginal costing is contribution. Contribution is the difference between the sales revenue and the variable costs. So if we have a look at how this would appear in a marginal costing statement. So within this layout, you will see we start with the sales revenue. Then we deduct the cost of sales, which is the opening stock plus the production minus the closing stock. The important thing to notice here is that when we are considering the production cost, we are considering only the variable costs of production. So that's normally the direct material, direct labour, and any variable overheads. Now, sales minus the cost of sales gives us contribution. We then deduct all of the fixed costs, and that gives us profit. So as stated earlier, there is no overhead absorption rates used. There is no need for an adjustment for under or over absorption. So let's take a look at an example of drawing up a marginal costing statement. So here we have a company that produces a single product. We're told that the selling price is £15, direct materials £5, direct labour £3, variable overheads £2, fixed overheads £1. Fixed overheads are expected to total £10,000 and we're told an overhead absorption rate. There are no opening stocks, and at the end of the period fixed overheads actually totalled £10,500. And we're required to prepare a marginal costing statement, firstly with 11,000 units produced and sold, and then a second statement when 11,000 units were produced and 9,000 units were sold. Now this example does have some information within it that we do not need. As we're doing a marginal costing statement, we don't need to know about absorption rates. So just bear that in mind. This absorption rate of £2 is not going to be needed. So if we start with our sales, we know that 11,000 units were produced and sold, and they were sold at £15. So that gives us a sales revenue of £165,000. We then need to work out our cost of sales. Opening stock is 0. Then we add production. We produced 11,000 units, and the production cost is the variable cost. And if we look back at the example, the variable costs are the direct material, the direct labour, and the variable overhead. So £5 plus £3 plus £2 gives us a production cost of £10 a unit. So 11,000 units at £10 gives us £110,000. We now deduct the closing stock. Since 11,000 units were produced and sold, there is 0 closing stock. So our cost of sales, opening stock, plus production, minus closing stock, gives us £110,000. Sales minus the cost of sales is the contribution. £165,000 minus £110,000, £55,000 contribution. We now need to deduct the fixed costs. And we are deducting the actual fixed costs, not what they were expected to be, not considering any costs absorbed. We are purely looking for a figure of our actual fixed costs, which were £10,500. And we have a profit of £44,500. And it's been laid out in a marginal costing format. So that's part A of the example. Part B is asking us to prepare a marginal costing statement again, but this time with 11,000 units produced and only 9,000 sold, so we have a closing stock of 2,000 units. Okay, if I do write this one up beside the other one. So sales, we are now selling only 9,000 units. So that's 9,000 times 15. £135,000 worth of sales. Then we have the cost of sales, opening stock, zero, production, we produced 11,000 units. We're doing marginal costing. So just to remind you, our production cost is the variable costs, which will be the direct material plus the direct labour plus the variable overheads. £5 plus £3 plus £2. So that is £10 a unit. Take away closing stock, and this time we do have a closing stock. We produced 11,000 units, but we only sold 9,000. So we have 2,000 units left, and we value them at the same figure as we used to value our production. And that was £10 a unit. So we are deducting this. So cost of sales calculation, opening stock of 0 plus the production minus the closing stock gives us a cost of sales of £90,000. Sales minus the cost of sales gives us a figure for contribution, £45,000. To arrive at the profit figure, we need to deduct the fixed costs. We know that they were £10,500. Remember, we want the actual figure for fixed costs, not a budgeted figure. So contribution minus the fixed costs will give us our profit figure, which is now £34,500. And that is your marginal costing statement layout. First example with no closing stock, and the second example with a closing stock. And that brings us to the end of this recording.